Hey friends, this is Martin from CUES, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show where we study the charts and then try to understand what exactly happened during the last week and then what we can learn from that and then plan for a better trade for the next week, right? And remember, this is for analysis for the week that's starting from October 3rd, Monday, tomorrow, 2023. Let's get into the charts and see what happened last week. Right. So this is the weekly chart of the Nifty that you see left side and Banknifty on the right side. Both have formed almost a hammer kind of pattern. The hammer pattern, of course, would have the wick larger size and a small body. The largest, very large size, right? A good part of this candle itself is wick. That indicates the support that's there downside, right? The bulls are giving the support from the downside and lifting the market up. So whenever a hammer appears at the bottom of a trend, it could indicate a reversal, potential reversal, right? That means if this candle was at this bottom swing low, then it would have made more sense. Here there's a pullback of nearly 10% that has happened and a hammer is formed still. It could mean a reversal of the short-term pullback trend, and then it could mean a reversal to the upside. There is a possibility, but the higher possibilities of hammer working is it in the bottom of a long-going trend, not a trend that is just a minor correction or pullback. Keep that in mind. So there is possibility for this one to work, and this is not exactly a full hammer because there is a wick on the upside also. Hammer, right, it does not have a wick on the upper side mostly, but it's almost like a hammer, you can say, and a hammer that is not exactly in a swing low or a end of a trend, but definitely the end of a short-term pullback. That's what it shows on the weekly charts of the indices, Nifty and the Banknifty. Moving on the daily charts, look at this. It was damn bearish the entire last many days, right, including previous week as well. But look at what ended up happening in the Nifty and the Banknifty, left side Nifty, right side Banknifty. Look at the candle. It is known as an engulfing bullish candle. Engulfing bullish candle simply means that the bulls have engulfed one or more than one of the candles. Right? That's what you see here. That is showing extreme bullishness is what it indicates, but it did not work always. Definitely there is either going to be some consolidation. There's not going to be an immediate crash back down. That much can be taken in the short term, in the daily charts we're talking about, not in the medium term. So reading along with this hammer pattern on the weekly charts and the bullish engulfing that you're seeing on the daily charts, there is a potential for some up move to happen on the upside, or at least a consolidation and not a down move immediately. But whether that up move would sustain or not is the question. You can see that there is a daily chart has got a gap here right above. Banknifty also has got a gap above the 39,500 levels. Here it is 300 levels. So whether it will sustain and move up, how long will it move up? Would this mean that this is another rally on the upside, or is it some pullback on the upside which may extend probably till 17,500, 400, whatever levels, and then again continue the downside journey or not? We never know that, but there is an arrest of the downfall that has happened temporarily on the short term, and that much can be well understood from the daily charts and the weekly charts, reading them together. Now looking at the Bollinger Bands, which shows the trend very much. There is an expansion that has happened on the Nifty and the Banknifty on the downside. This zone that has happened before in the September month has been consolidation. Price has been going up, going down, going up, going down, all within that range of 18,000 and 17,000. But that's over. That's history, and now it is an expansion that has happened on the downside. This is an expansion on the upside. Same as happened in Banknifty also. So overall, the Bollinger Band still says that there is a downside bearish biased expansion, not a consolidation yet. When both of these bands again skews and then come to another contraction, that would be the time when we say it's sideways. But right now, indication by the daily Bollinger Bands is still bearishness below the median value of 20-day MA. Nifty, Bank Nifty, another view on the weekly is what you're seeing. You can see that the trend line resistance that we had been talking for several months together, which was tested 1, 2, 3, 4, 5, 6, 7, like at least 7 to 8 or 9 times it was tested, and we can see that it did not sustain and it has given a pullback, and now it has taken a support of the 50 DMA and managed to test closes right on the 20 moving average, not 20-day moving average, 20 weekly moving average. Similarly, the Bank Nifty, this is the trend line that we had been talking, trend line resistance. It is actually a neckline of a rounding pattern on the weekly, which could not be conquered, and then price could not move further up, failed for the second week. Nifty failed for 3 weeks. Bank Nifty this week confirmed the bearishness, but with a hammer that has taken a bounce from the 20-day weekly moving average. Right? That's what you read from this chart, a different view of the same thing that we have been talking about. So it's a mixed bag. It's a mixed bag. Right? Price patterns indicate both. It's very difficult to judge because there is a possibility of a reversal, but that reversal, would it sustain? Nobody knows. Overall, it is bearishness that continues as of Friday. That's what is learned from so far. Now, moving on, support resistance levels is what we are more important, right? Because prediction does not work in market. Market could move up, break supports, break resistances, or break supports on the downside, or stay within the range. These are the 3 possibilities that is there, and all we need to know is which are the supports and the resistances, and then which would give us probabilities of the price slowing down or picking up pace at those levels. That's what traders only need to know about, right? Rest is all just analysis for the sake of it, I would say, right? So support resistance levels 16,750 would be a good previous swing low. After that you have 16,650, which is a gap support. A breach of that would be a concern, right? Would indicate that we are going down for real, right? After that you have 16,350 nearby range, then we come back to the 16,000 nearby range, 16,050 range. Both of that has got supports from the gaps where previous gap ups have happened in the previous rally that extended to probably 20% or something. Now the 10% pullback is there. We don't know whether it's going to further extend to a 20% range, or is it going to take some more breather and then go back. We don't know. But these are the levels on the downside. On the Nifty on the upside, you can see 17,161 is the previous swing low. As well as it was a support zone, now it's it could access the resistance on the upside. 17,300 to 91.65 exactly the gap resistance on the upside. That is cost. So that would be the major first hurdle we would say. Right? If we clear that, we can say probably, right, it may take some more time before it can move down at least, right? So 70,500 is also a zone. If you look back, you can see this is a zone where there's resistances earlier, which was breached recently, but that could again act as a support, resistance now. That support would act as resistance now. Above that, 17,726 kind of levels, the previous swing high. Then 17,850 would have a resistance. Then all previous swing highs or resistance zones. 17,992 would be resistance. 18,000 rounding number resistance would be there. 18,115 resistances. They're all resistances on the upside. The supports we already have seen. Right? Bank Nifty similarly would have the first resistance would be a gap at 39,400 levels, right? And then above that 39,750 also could be a previous resistance zone that could again act as a it was breached earlier, and the support was exactly as a support that was breached, and now it could act as a resistance again. Above that 40,500 levels, then 41,150 levels. Likewise upside. Downside 37,250 would be a previous swing low, and then you have a gap at 36,808, which would be a major support zone, and if that is lost, we have trouble. The next gap support would come at 35,750, 761 levels, and then below that 34,400 nearby levels, 34,388 to be precise, right? That is all gap supports on the downside. On the Bank Nifty is what we are talking about. Moving on, now that we have seen support resistance, price patterns, Bollinger Bands and all that, Moving on to indicators, the momentum of the price, the momentum of the price and the trend of the price. Look at this. In the Nifty 50, dailies, weekly is what you see on the top, and daily downs, daily on the right side. So it does mean that we have reached the weekly momentum, and daily momentum is climbed back in the sideways. So both are sideways, we can say, as of now. Sideways, with the fall in the weekly is what happening, in a rise of a one-day rise that we are seeing. That is, whether it will stay in the sideways zone or not, only Monday will tell that. So sideways overall on both the indices, both the charts, weekly as well as daily, medium term as well as short term. Banknifty, while has slipped and breached and fallen into breach that support of the RSI 60 and then fallen into the sideways momentum, you can say, on the weekly and the daily. Also, it has managed to climb back on Friday's move into the sideways one. Whether we sustain that sideways one or fall back, we never know. Right? So that's what momentum remains to be sideways on all both the indices on all time frames, medium term as well as short term time frames. Now, ADX is the indicator that we use for finding the trend. The trend remains in the bear zones. Right? It's in the bear zones on both the indices, on both the time frames of short term and long term. That means daily and weekly. Right? It remains in the bear. So the trend nothing has changed by just a Friday's move yet. Even in the short term, it has not changed. Momentum has picked up, but trend remains bearish. But it is of weak strength and falling strength. That is then the falling bearishness, as you can say. The bearishness just don't have enough strength just because of the one day move, Friday moves. But otherwise, trend does not change. Momentum slightly is climbed back to the sideways. Moving on, volatility and the open interest analysis. If you see, volatility has cooled up a little bit last week after a big spike up to 22 kind of level, 6.3% of cool off has happened, and it's 19.96 as good as 20. It's time to be very extremely cautious because global cues are not that great, and anytime it can spike back to 22 and probably beyond that, but the market could crash. So stay out of the trade if you are into derivative and option instruments if it is spiking above the 20 again next day, right? So wait for that to cool off really to the 18, 17, 15 that kind of levels before you can, at least till the 17 or 18 levels before you can get back to trading on those instruments. Now, open interest analysis for the Nifty showing a futures, especially futures open interest we are talking about. It's long and winding, which is kind of a bearish build up on the Nifty. Banknifty showing short covering, which is bullish in nature because you're trying to cover the shorts with the long calls. Yes, people are building up long positions. Right? So there is a contradiction there. Nifty is weak as compared to Banknifty, but open interest for the futures are showing. But August 6th weekly expiry options data is showing a PCR which is also bullish, 1.08 and 1.16. 1.16 in Nifty. So that's clear bullishness on the OI is what you see. Right? It all happened in one day's move. Put call ratio is bullish for the weekly expiry that's coming next Thursday. But bullishness is not evident on the Nifty yet based on the futures OI built up on latest futures OI built up. Right? That's it. A week at critical levels, crucial levels, caution required levels, and OI, for the next expiry definitely shows bullishness. But Nifty, bullishness from the PCR point of view, but from the futures OI build-up point of view, Nifty is yet to show that. Look at these levels for the expiry of October 6th next weekly expiry, 16,700 and 17,500 for the first highest put writing and call writing is seen respectively. 16,000 to 18,000 is the next level of highest put and call writing support and resistance that is seen. 37,500 and 41,000 is where the highest put and call writing is in on the Banknifty. 37,000 and 40,000 is what you see the second highest put writing and call writing that is seen. Right, so that's all right. It's bullish PCR and futures also bullish on the Banknifty at least, and range of the levels are wide apart because the writers are seeing that there is volatility that is going to be, that's evident from the OI data. Right, so make a note of these levels, correlate that with the support resistance levels, and then accordingly you can enter exit. Right. Moving on, sectorial watch. most sectors we're trying to analyze which sector is doing good, doing bad, and all this, right? So interestingly, we had big downfall and up move, right? It was a single day up move, and otherwise big down move is what happened last week. So what do we have? It is the IT and the pharma, two different sectors. IT has beaten up because of the US market fall down, which had shown some up move, 1.4% on the IT, but not yet good enough from the momentum perspective. It's still in the sideways on the short term. Weekly definitely still in the bearish zone, so stay away from it. And pharma, yes, it is 2.7% up move, and it is only sector that is bullish on the short term. Right, medium term is still sideways. FMCG maintains bullishness from the weekly, but short term it is sideways only. Right, FMCG is down 1%. All others were also down last week. Reality was 3% down. October was 3% down. Metal was 4.4% down. Right, all are sideways momentum. Right, on the short term. Reality has got a bearish momentum on the weekly. It continues to be there. Right. Reality is on the medium term also it's weak. Right. And IT also medium term it's bearish. It's a mixed bag, but defensive sectors in the short term, if you see, defensive sectors IT and pharma has done well, and pharma is really doing good. Those only sector that may be really doing good, but not good enough to take long versions, right? So there is a hammer pattern that is seen that could be indication of a bullish support that we have at least, if not for reversals. FMCG is showing hammer. Reality also is showing a hammer. That means it was beaten down and then tried to climb back up. Right. There is a positive reverse divergence that can be seen on the auto sector. So that could still work out to give a bounce up. All the 3% is gone last week. Right. So that's how the sectors are performing as of now. No clear indication on which sector can be super bullish. Nothing. But pharma leads the pack. It's the same sectoral analysis on the charts that you see. Right. So it's consolidating and trying to take the support in the IT with the climb back on the sideways momentum. And on the metal, it's falling down momentum, which is facing the resistance on the upside. Auto is bullish definitely, but it has posted reverse divergence. It seems to have worked out, and it has given a pullback. There is a crossover to the bearish zones that has happened on the weekly time frame. Momentum, if it is not holding the support 60, it should maybe good. The support is crucial for it. Otherwise, it may fall a little more back, and then the neckline it may come in, and then from there it may climb back. It's not that bad if that divergence works out on the auto sector. You can see. Pharma, as we said, it's breaking out of the channel, and it's facing resistance on the upside. But overall momentum is climbing up, trend is climbing up, but not at fully, bullish enough on both time frames. Right? Weekly is still lagging. Yeah. FMCG, as we've seen, yes, it's in the bull zones. We have a neckline down here, but it's an inside bar, probably consolidating. FMCG is also a defensive sector, which is staying strong in spite of all this correction that has happened in between. Reality is also falling down momentum with the momentum close over to bear zones, pretty close to a neckline support, which may work, and if that breaks that support zone that we have, then we have trouble. That's reality. Next is the index heavyweight HDFC Bank chart is what you're seeing. A small body is always in this view, medium term sideways movement, and the trend is bearish, even though we had a pullback. HDFC Bank is what you're talking about. HDFC is also given a pullback hammer pattern, can we see, and it's facing resistance on the upside. Right. Downside, a lot of supports are there, and we'll have to see whether it's able to take that resistance, or it spend considerable amount of time after which it had fallen down. We'll be able to climb back there, is what you will see. HDFC Reliance Industries has a neckline, and he breached from here downfall. It's a major support zone further till the 2050 kind of levels, right? Whether it's going to sustain there or and climb back and move up and break out further is the thing that you have to watch out. But momentum is sideways on the medium term, but the trend remains to be bearish on the medium term. Index heavyweight Infosys, you can see greens That is support zone, major support zone. We have marked that. TC is also support zone. The momentum is bearish on the medium term. Continue to be, right? It's trying to climb back on the sideways zone on the medium term as well. I see the bank showing a hammer from the support zone, and it could be a change in polarity bounce. It's possible. Already just a client breakout had happened and given a good correction. Now momentum has got post reverse divergence, which would take a support of the RSI 60 and then bounce up. So ICICI Bank definitely giving bullish looks, but there is a trend that is about to cross over. If this crossover happens, then we have trouble on the medium term. As it now looks good. Actually, that support bounce could work out, and then there is a possibility that the price can move up if it moves up with the price. This last week's candle high. Kodak Bank has been consolidating forever, and once again it has hit the resistance and fallen, and the sideways momentum has medium term has crossed over to the close to the bear zones and the medium term. So it may mean, but hammer is a good thing that it is probably taking the support of the previous support and then maybe consolidating, or maybe falling down to this next support zone. So it has been consolidating like this for very long time without doing any breakouts either on downside or upside. That's Kodak Bank. So ICICI seems to be very strong. IT seems to be consolidating, and the rest is all sideways zigzags and neckline points, trying to struggling to maintain that sideways momentum on the medium term is what we saw the index heavyweights. Right. Moving on, institutional participation. If you see, 15,860 crores of selling has happened from the Fyers last week. Worrying factor, but look at DI buying, an equal and more amount of support has come in from the DIs, domestic institutions, last week. That's why market did not crash. But we still lost some points, 200 in all. There was a pullback, which means that there was panic in the retailers, and retailers have been also to make it trades on the long side or selling off. So net longs also has moved down on the derivative side by the institutions. FIDA also from the derivative side, derivative instrument also is pull down. So institutional participation from the FI side, definitely they will pull back the money when the yield is rising and the US dollar is rising. The money would flow back to their native. It makes more sense to invest in elsewhere. But that's a outflow that is happening. But at the same time, buying would come in when there is seen as it is seen when the DIs is supporting. Money would come back like it had come back 2 weeks back. Okay? But it's a concern as long as the FIs are not bringing in money, the market rally would not happen. Rally would happen only when the FIs come in. But domestic institutions supports and the retail confidence in the market is very indicative of the equal amount of buying and selling that is happening from these two institutions. Global markets. Moving on. US markets, that's a real pain. The Dow Jones, S&P 500, Nasdaq all have fallen 3% or more down, breaching the major supports on last Friday, US Friday, after our markets basically. So medium term and short term trend is clearly bearish. You never know how long it's going to fall. I mean, how long, right? It could break and take this. It is possible to go to the 125 kind of levels on the Dow. Similarly, a breach from here on the S&P 500 could take it to 3412 kind of levels. Another previous swing low is at 32,000, 32,000. All these are supports, but market is extremely bearish, is what you can see the US, and it has taken breach as support. This is a real way. 3% down. Previous week also 3%. Before that 5%. So that's a breakdown that's happening in US markets. That's a real pain. Dollar is another pain. Dollar is shooting up. Another nearly 1% of up move happened this week. 112.7. It shot up to 114 on 20-year, multiple year high levels, and then USD INR. Look at how weak the rupee is. Right? Some pullback had happened in the dollar index last week actually. Right? After making the 114, but in the USD INR, it was further shooting up at 0.3%, and it even hit the 2082 kind of levels. Rupees at the week, it's a big trouble. Dollar rising and rupee weakening is big trouble. US markets bearish, big trouble. Money is flowing out. Crude oil is the only relief that we have once again. Second or third week of relief. It's below the 80, and it is formed a dodgy inside bar kind of formation. It's indecisiveness. Should it further break down from here or not? Is there a recession or don't have it? That's the question. recession would reduce the demand of the oil, so price could fall. So is it heading towards the 81 kind of levels is what we are concerned about, right? Look at the oil charts, crude oil charts. It had made 11-year high and all that earlier after hitting the 101 plus kind of levels, and then fallen down the trendline channel and then breached the support zone, and then looks like it's heading towards $61 barrel kind of levels. Moment is the bear zones, trend is clearly in the bear zones on the medium term and the short term. Trouble. Gold. It is hedging instrument and it's in the bear zones on the medium term and short term. It had a head and shoulder breakdown. Major support zones was breached 1, 2, 3. All weekly charts. All support zones are breached. Now, if it falls, it could be a big fall. But last week it is showing some attempt to climb back. That's what you see here. Will it sustain or not is not clear because the close has not happened above the support zone. Momentum is bearish, trend is bearish. Trouble. Yeah, because it's just trouble because it's a hedging instrument by where investors put in their money on protecting their investments on the equity side. So yes, so it's trouble cues are negative for sure from the dollar rising and US market perspective. Crude oil perspective, there is some relief that is there. Right, this is the dollar rising that you can see. It had a pullback that happened on the dollar index, but USD INR currency pair is shooting up further after making an all-time high at 114 plus kind of levels. Right, so that's it. Right, that's the global cues. Now moving on, next topics for the next day. Two of them. One on the short side, it's Pyramid Enterprises. It's a diversified company which has pharma as well as financials, and it's a head and shoulder breakdown that you can see there. Any entry below this week's candle could give a very good short side swing opportunities. Of one more than 1:5 kind of levels. 570 can be the target support zone. Because the moment is bearish and the trend is also bearish, and the price patterns are extremely bearish, so that's why we picked that. While the Airtel rectangle pattern breakout, right, it is breaking out and it is a confirmed green candle, and the price movement above that could make a move as much as the height of this rectangle or the box. Moment is extremely bullish. Trend is also bullish on the medium term and the long term. So while the Airtel is a long, Pyramid Enterprise is a short for the next week. It's a swing trade, it's not a one-day trade. Moving on to the Nifty strategies, here we have an undefined risk, but look at the range that we have. It's a 1,000-point range that we have got. As long as the market does not move up and break the 18,000 in just 1 week, and as long as it does not breach the 16,000 in just 1 week, which is kind of more than 1,000 points, which is less likely to happen 1 week, but still cannot rule out the possibility. So this is a ratio spread that we are seeing where we are selling, out of the money, where we are buying, out of the money and then selling twice of that furthermore out of the money. Right? We're not completely hedged, but as long as this breach of this level, the break-even point happens a little before that, if you just buy a hedge at the ATM price on the both sides, where our side is moving, instead of buying it ahead of time and then giving out profits, whenever there is a breach that happens a little before that, if you can buy out, you can reduce your loss at least. But there is a very less possibility that such kind of movements happen. Very, very rare possibility. So that's why if you still don't want to believe that, you can buy the hedge as well, but then your max profit will reduce. It's a strategy that works and it gives reasonable probability of profit and a good range above that. Right? That's what when the market is very volatile, the range is very important. It's a trade-off basically between the probability of profit just for one and the range that we are getting. Right? You trade off something there and then get something here. Right? So that's a Nifty ratio spread that you see. Options trading strategy on the Nifty for the next week. Yes, now that we have been talking a lot on the market weekly analysis and study, let's conclude what we have to do. Right? So it is actually a confirmation or a reconfirmation basically on the Nifty and the confirmation on the Banknifty probably of the bearishness that we had been talking about the previous week. But despite that, the market was confused a little bit by giving a short covering rally or with a bullish engulfing pattern on the daily and a hammer pattern which could possibly be a reversal indication. Right? It is confused, but it's giving hope to the bulls. But this move, whether it may sustain or not, we'll have to think twice because overall the bearishness is very much evident from the price patterns, from the swing high and low, basic price action principles. Bullish high PCR that we talked about, which is 1 point plus, and CIP support levels change it by a bounce possibility because it's at a support zone, which was a previous resistance. That CIP bounce thing, the daily candles are bullish, engulfing, and the weekly chart candles are bullish. Momentum climb back, from the bear to the side, and oil call-offs, defensive sectors performing like fighting and former coming back from the bear to the sideways zones and forming bullish zones and all that in the short term. So all good cues in favor of the bulls. Right? But remember, overall the trend is bearish. That's very much evident. You have a trend indicator which is not crossed over, it still remains in the bear zones. You have the Bollinger Bands, it's expanding, the Fyers are selling, the higher wicks, the price action swing levels we close inside that trend line resistance. Weak rupee we have, and the global cues are really bad. So just the view for the next week is still bearishness, but with some mildness added to that, assuming that there will be some up that can be expected out of that bullish engulfing, which may not likely to sustain. So mild bearishness. These markets are crazy and they are at heavy bearishness levels. It is broken and slipped from the trend line, support zones, everything, channel trend line, support zones, everything. And we have not just we all the markets has dependency on the US markets from the dollar perspective, and then because fire money definitely comes in from the US primarily, right? So we may be decoupled, we may be resilient, but we may not be recoupled forever if big crashes further continues in the US market. We just can't ignore that. That's not possible. Global cues are not that great. Ukraine thing, China thing, repo rate hikes, inflation hikes, and all this. Remember that last week's spike up was just because the RBI increased the rate to the level that the market expected. Market had already discounted that. That's why we had a spike up. There's no real reason to be happy about when the interest rate is increased for the market price. But interest rate is increased as per what market had digested is why market rallied slightly. So overall global cues are not great till now. Crude is at little cool off has happened, is the relief, but look at rupee. That peak at 82 rupees for $1. It's not great for the market side. So the rupee US markets are plenty of global cues which is reflected in the India VIX, which is touching the 20 and then in fact should up to 22, and then anytime you can go back there and beyond. So we have to look up is 16,650 for the next week, 37,000 for the next week on the downside. If that bridges, we are trouble upside. It could go up to 17,500. Above that, it may not happen. If it happens, yes, well and good, but still we cannot say that we are out until we've reached that resistance trend line, which we breached earlier on the downside, right? That's it. So all we can do is risk management, portion sizing, right? So always cut short your portion size or stay out of the trade if the VIX is spiking above the 20, right? Either cut short, portion size, trade less, stay out of it, all things that you can. But if you're trading, especially talking for options, derivative instruments that most of us do, so if you're trading, and you're taking overnight portions, do not do without hedge portions, right? Because that's the only way to protect your capital and for you to stay in the game. Otherwise, you get wiped out very easy at this kind of volatility, right? So always another thing is the protecting the quality stocks that we want to keep for 10 years or longer term. How do we protect that? We have the playlist, we have the cash secured puts and strategies to invest in SIP mode, or we have the covered calls to protect, get regular incomes, and all this are there in the playlist. Check out that and use such strategies if gold is not working out. So Yeah, save your capital, risk manage. That is the only thing that you do when market is uncertain and market is crashing and things like that. Right? Hope this helped you to frame a view of your own for the next week and to make a trade plan as to what to do by watching this video. If it has helped in some way, please do not forget to subscribe and share it to maximum. We have very few subscriptions, as you know. I appreciate your help in this regard to keep us motivated on this. Thanks for watching. Happy trading, happy learning. Bye bye.